One of our Fundamentals of Finance Academy members recently asked us how to transition from a growth-oriented portfolio to an income portfolio as he nears retirement. And I thought, I bet he's not the only one out there wondering how to do that. And if you're wondering the same thing, you've come to the right place. I'm Ethan. I'm a chartered financial analyst and investment professional, and I'm going to show you how to do that in this video. First, we'll cover the basics of how to adjust your portfolio and why to do it, then when to start adjusting, how much to invest in stocks and bonds at each age, and then a better way to manage your money in retirement. Now, that last part has produced extraordinary results, and it's super simple, so be sure to stick around for it. But I'm getting a little ahead of myself. First, let's start with the alter basics just to make sure that we're all on the same page. Earlier in life, you want to invest in more stocks because they have higher long-term return potential than pretty much everything else, certainly compared to bonds. They go down sometimes, but when you're young, you've got time to recover. Also, when stocks are down, it gives you a chance to buy more shares at a lower price if you're still working and making regular contributions. Volatility can be your friend, but once you're no longer working, you typically want to invest more conservatively, meaning holding some stocks, but not as many, because you need to rely on your investments for income. You don't have as much time to make up for losses, and that makes short-term risk and volatility more important to consider. So, when should you start reducing your equity exposure and getting more conservative? And what should your ultimate allocation be? Well, as a baseline, let's start by looking at how Vanguard does it in their target date series. Many people have a target date fund in their 401k. You might even have this exact one. It's pretty popular. But even if you have one from another company, they all work pretty much the same way. The date in the target date series refers to your planned retirement date. These funds adjust their assets over time to get more conservative and prepare you for retirement. You can see how the green or teal colors refer to US and international stocks, and are the highest, about 90% combined, in phase one, which Vanguard calls your early career. Then they start reducing when you're 40, which Vanguard calls the transition phase, and they keep gradually reducing until you're 72, 7 years past retirement. From then on, they stay the same at 30% stocks and 70% bonds. I'm sure they've got a lot of smart people there coming up with these allocations, or what's called their glide path. And every company does it a lot like this. So if you want to do it this way, I'll understand. But if you stick around for one more minute, I think I can prove that I have a better alternative. Let's go back to the early career stage. Since age 20, they have you in 10% bonds. That is, quite frankly, insane to me. Here's why. Over the last 50 years, or really 51 now since I originally created this chart a year ago, the odds of losing money over any 20 or 30-year period in the S&P 500 were zero. It never happened. Not even with the oil embargo, 9/11, the tech bust, the global financial crisis in 2008, a once-in-a-century pandemic, and many other crises along the way. You still never had a single time when you could have lost money. Actually, over all 30-year periods, no matter when you started, the worst you could have done was a 9.3% annualized return. That's actually better than the best 30-year return you could have gotten in bonds. So why the heck would you invest in bonds when you're 20 years old? And you know what's really crazy? I actually work for a company that has a prominent target date series, and I know the people who manage it. They actually did a massive study looking at the optimal asset allocation over 30 years. And guess what? In every single scenario, 100% equities was the best. So, of course, that study never saw the light of day because the standard industry practice is to have a little bonds in your target date no matter what age you're at. They know it's likely not optimal, but they all do it anyway. So, what is optimal then? Well, that's what we're going to cover next. But before we do, one more thing that's crazy to me is that 71% of you that watch this channel regularly haven't yet subscribed to it. So could I ask you a favor before we continue? If you like this channel and you're getting value out of it and you want to support us, the free and easy way to do that, it would have a massive impact on our lives and cost you nothing, is by simply hitting that subscribe button. My commitment to you is that if you do that, my partner Kyle and I will do everything in our power to help you improve your life by becoming a better investor. Thank you so much. So let's get back to it. When is the optimal time to start your transition phase? The short answer is we don't really know because we can't predict the high point of the market. If we could, it would be then. But we can make smarter choices to increase the odds of better timing, and that starts with our prior observation that the chance of losing money over a 20-year period in the stock market is, let's just say, very low. I know it's 0% in the S&P 500 over the last 50 years, but let's just call it very, very low. Anything is possible. So that means that, in my opinion, the transition phase shouldn't start until you have less than 20 years until your planned retirement date. From here, I'm going to give you two versions: the practical answer I should give as an investment professional, and what I would personally do myself if I were nearing retirement, given that I'm quite comfortable with stock market risk since investing has been my entire career. The practical answer would be to gradually shift from 100% stocks to about 65% stocks, give or take, beginning about 20 years before retirement. So, if you were planning to retire at 65, they could look something like 100% stocks up until age 45, then reducing them by about 1.5 to 2% per year until you hit 65. In my research that I've done, about 75% stocks is actually optimal for the duration of your retirement, assuming they're well diversified and on the conservative side, like quality dividend paying companies. If you have more aggressive equities, you should own fewer of them, all else equal. By the way, I would consider the S&P 500 to be more aggressive than what I'm referring to for a retirement portfolio. It's also important, in my opinion, that the bonds you hold are high quality, not junk debt that pays out a massive yield with a ton of risk. Those kinds of bonds tend to go down at the same time as stocks do, so it kind of defeats the purpose of holding them, which is to do well and provide a ballast to your portfolio when equities are falling. So, conventional wisdom is 60% stocks, 40% bonds. My research says 75% stocks, 25% bonds, as long as the stocks and bonds are conservative. If you want to learn more about how to build your own personalized retirement income portfolio, what you'll get to at the end of your transition, we showed you how to do it step by step here. And that would be a great video to watch after this one. But before we get there, let's dive deeper into the transition phase. I told you the professional answer to give would be to start at 20 years from retirement and adjust your equities down by 1.5 to 2% per year. But if it were me, given my high risk tolerance and comfort with stock market volatility, I would wait longer and base it on what the market is doing. My analysis involves two basic parts. Part one: when would I start considering getting more conservative? About 5 years from retirement. Here's why. According to the always questionable AI, the odds of losing money over a 5 year period in the stock market have been about 8 to 11%, which does sound right to me since in my own research, it came out to 9.1% over the last 50 years. Obviously, the precise percentage depends a little bit on the time frame that you use in your study. So if you start getting more conservative 5 years out, does that guarantee it you won't lose money and you'll be better off than if you started earlier? No. But if we assume bonds will get a low bond-like return of maybe 2 to 4%, then I'd say the rough odds of being better off investing in equities for that last 5 years is about 85 to 90%. And I'll take those odds personally. But I'm not saying I would stay in equities for the full period, just that I would start considering getting more conservative at 5 years out. My second consideration, part two, is when would I actually start? And it could be 5 years out, but I might wait, and here's how I would decide. This is the Shiller PE in the dark blue and the S&P 500's return over the following 10 years in light blue. The Shiller PE is a measure of how expensive the stock market is. And the more expensive it is, the lower returns in the stock market tend to be going forward. It's not perfect and it's not guaranteed to work in the future, but historically, it's been a pretty good predictor, at least directionally, of long-term returns. Now, I want to emphasize that. It's a much better predictor of long-term returns than short-term ones. So it doesn't really tell you there's about to be a market crash or anything like that, despite what some headlines might say. But if this measure was above 30 and I was 5 years away from retirement, I would start my process of gradually getting more conservative, maybe moving 5% out of equities into bonds each year for 5 years until I got to my 75-25 mix. There's no magic silver bullet to getting perfect market timing, but this is widely considered to be one of the best indicators out there, and it should always be pretty easy for you to find with a quick Google search for Shiller PE. That's how I would do it. But for an added bonus, which I've already shared with our Academy members, here's how I would aim to enhance my returns in retirement. This strategy is so simple and so powerful. I honestly can't believe why nobody else is doing it. If you haven't figured it out, I don't know. But this is a massive game changer. The strategy is based on three very simple and, I would say, widely acceptable premises. 1. Stocks generally beat bonds in good times and trail them in bad times. 2. Because of that, you can enhance your returns if you own more stocks when the market is going up than you own when it's going down. And 3. the stock market always eventually recovers after it goes down. I started my research project by looking at a standard 60/40 SPY BND portfolio rebalanced annually. Rebalancing just means readjusting your portfolio periodically to get back to your target allocation. Since some investment will always inevitably do better than another investment you own, making them larger portions of your portfolio than you originally intended. That baseline portfolio, 60/40 SPY BND, returned 9.02% per year over the last 10 years as of June 30th, 2025. But if you want to own more stocks when the market is going up, then you own when it's going down, and you know that it'll eventually recover when it's down, then what if you started with the same 60/40 portfolio, but every time the S&P 500 fell 10% from its peak, which is called a market correction, you added 10% to your SPY. So you made it a 70/30 portfolio instead of 60/40. If it dropped 20% below its peak, which is called a bear market, you go up to 80% SPY and 20% PND. So each time the market drops 10%, you increase your equities by 10% and reduce your bonds by 10%. And then whenever the S&P recovered to its prior peak, which I use total return for this, not just price, by the way, you would just sell whatever extra equities you had and rebalance back to the 60/40 baseline portfolio until the next correction. That way, every time it's down, you're adding more equities. And then when it gets back to normal, you're back to your baseline. You're not being greedy. You're not taking any extra risk. You're not having to try to predict what the market is doing. You're just literally following this very simple formula. And of course, if the market is always recovering, and you always will own more equities when it's going up than you do when it's going down, because you're adding to them when it's down and you're selling equities after it's gone up. Simple, right? This portfolio returned 10.53% over the last 10 years. It added 1.51% excess return annually, which would have been a difference of about $350,000 more money in a $1 million portfolio over 10 years. This is huge over time, and this strategy is super easy to implement. For the 10-year period where I tested this, it would have beaten almost every single balanced mutual fund or ETF in the industry. And that's also true over the last 3 and 5-year periods. It beat the standard 60/40 portfolio by 1.95% per year over the last 3 years and 1.69% per year over the last 5 years. Of course, the amount will change in different market environments, and I didn't test it any further back because, to be honest, this research was just ultra time consuming. But I can't imagine a scenario where this would ever not improve results over, say, a 10+ year period, unless the market literally just kept going down forever, which is practically impossible. Now, if you don't hit the like and subscribe button after that bombshell, at least please leave us a comment and let us know why.